So we got the pullback that we've all been waiting for, right? And almost got a 1% drop. And man, it looked like we're going to be bearish today. And the TV networks were gearing up for their, bear market graphics. And middle of the day, cleared all that selling off. Finished with a little bit of a loss, but quite the roller coaster, down and up. So I break that down today. How did that impact expectations? Some interesting candlestick patterns develop that can impact posture going forward. So I'm going to break that down. Also, there's some interesting names are pulling back. Is it pulling back to potentially some opportunity for some nice, good bullish bounces? So we're going to take a look at one for our trade idea of the day. Let's go ahead and get started. Today is Thursday, November the 9th. Is it 9th? Yep, November the 9th, 2017. This is the Market Outlook. My name is David Settle. Quick disclosures here. Remember, this is for educational purposes. I'm not a licensed financial advisor, so keep that in mind. None of this is recommendations or advice. I'm meant to help you. Basically, you can kind of see how I look at things, and hopefully it helps you figure some things out as well. And that being said, a couple things I want you to do. First, welcome to those that are watching for the first time. I saw in the YouTube comments from last night that we had a first-time listener. So if you have any first-time listeners tonight, welcome. Thank you for joining us. Hope you keep coming back for more. There's a couple things I want you to do. Number one, I want you to subscribe to this YouTube channel if you haven't done so already. You can see there's a red button below that says subscribe on it. Once you subscribe on that, a little bell shows up. You can click on that bell. That will notify you through email by default, but also you can set it up to notify you by SMS, text, when these videos are posted. So do that. The second thing I want you to do on Twitter is I want you to let me know that you found this video useful by clicking that heart. That likes the tweet. And then if you think other people should watch it, hit the retweet button. Once you do those two things, Twitter will start promoting that tweet and this video to other people that would be interested in this kind of content. So if you want to help out, let me know that you liked it. Do those couple things. One more quick thing we'd like you to do as well is fill out this survey. We're up to about 700 surveys now, which is amazing. So thank you very much for those who have filled it out. For those who haven't, our goal is to get to 1,000. So if you haven't filled it out yet, please let us know how likely, how interested you would be in joining a company that Brandon and I are working starting this week. We've been working and putting together, as well as what you would like that company to offer in terms of services, in terms of tools, in terms of topics that we teach, and where we can reach you and connect with you on social media, and then finally a comment section here on what you would like to see in that company, an ideal investor education company, based on what has been beneficial for you in the past. And again, leave your name and your email address, because those who have helped put this together, we want to make sure we do right by you and we get going to be able to offer you an incentive for doing that. So just leave your name and your email address there so that we can keep track of who helped us put this together. Again, you can find the link to the survey down below in the description of the video. There's a link to the email newsletter list, so join our list, and then also the link below that would be to the survey. All right, let's take a look at the S&P 500 first. You can see a long lower shadow. In fact, we've got a couple of buying the dips. See, these are all buy the dips, all within a single day. I mean, we can't even get a 1% drop. I know at the beginning of the day, it's watching the telly. And I mean, people were kind of, talking about the fact that we had a 1% dip and how crazy that was. And yeah, that didn't last long. It didn't even last like past lunch hardly, as we started to right back up. And now you can see it's a flat line there, which means we're right at the open. The close right now is right at the open. Now I am doing this a little early today because I do have to have an appointment in the afternoon here. So I'm going to put this out so things can change definitely within the last 20 minutes here or so. But it's long lower shadows. Remember, there's a little bit of a bearishness here, offset by the rally late into the day. But that low point here is going to act as a support level. These are typically bullish candles. As you can see, the last couple we came off of that, off of this near-term low here, and then of course, what was a near-term low before we rallied in the middle of the day and brought the near-term line back above 50. Because at the end of that day here, the near-term line was down, and the momentum line was also down in the reversal zone. But we reversed by the end of the day and finished up, and that brought both those lines up and kept the near-term line above 50. So that was kind of like a mini near-term low point. and the fact that we had a near-term low, we were below 50 on an intraday basis, just didn't finish there, and that's what matters, is where we finish. But you can see, again, we get the long lower shadows and we rally, and when we don't rally, they act as support. Even here, this long lower shadow here, we didn't rally because it was a top, it was a hanging man. But you notice that lower shadow act as a support on the closing basis. We got another long lower shadow here, came back above that low point by the end of the day, rallied. A little bit of a hammer there. So those are bullish candles. You can see now we're starting to go past today's open just a little bit. The posture is strongly bullish. The market sentiment is very high. It's almost a 90th percentile. Remember, when we're above 80, we don't get very much gains. So when we first got above 80 here on the market sentiment, which is right there at that gain, so that was 25.69. We're at 25.84. So I don't expect big moves here. It doesn't mean we can't go up. I just don't expect it to be obviously nearly as strong as even these moves were coming up off a low point below 70, much less a low point that would have been below 50, where we would have got much stronger moves. So the bullish trends are intact. The near-term line is down, but still above 50. So that's what now 10 days up above 50. You want it, 7 to 12. I mean, that's typical. And then now it's not very typical for coming off such a long extended run. And even before that, you had a nice good run, a typical run here. I mean, this is a healthy near-term rally, small little pullback to like 23%, if that, Fibonacci retracement. That was a little unhealthy rally because we had this move, which was normal. Then instead of pulling back, we kind of went sideways for a while. You could see what happened. And then we had another leg higher. So we didn't, I mean, here it was, a small pullback, like 23% Fibonacci. Here we didn't even get that. We just kind of went sideways and then made a couple big up days. Then we got a little bit of a pullback again, about 23% Fibonacci because of how big that run was. And then now another healthy near-term run. This is normal. These two are normal. Not so normal. It would have been normal right here. This is normal. This is normal. And now we are getting a little bit of a pullback. So don't be surprised if we don't fill in this shadow here in the next day or two enough to bring this near-term line below 50. But remember, holding that long lower shadow for support level. Just like we talked yesterday in the Russell 2000. Take a look at that really quick. You can see it's also getting another long lower shadow. So now we have a new support because that one, we breached it on the intraday basis. The closing base is what matters. But now we have another long lower shadow. It's even a little bit lower. So we have a couple little layers of support here on the Russell 2000. Remember, it's already had the weakness that the large cap indexes have to both kind of catch up to. And its posture is getting increasingly bearish as its intermediate line is close to being down below 50. Now remember, its market sentiment's pretty high, so it's not like we're threatening a long-term trend here anytime soon. We are because that near-term rally was so big here on the Russell, a lot of that tax reform related, a lot of this tax reform related, pulling some of that back. Then this is just a normal 38% Fibonacci retracement and a 23% retracement of the intermediate rally that we had that included this leg over here. The long-term trend showing some little bit of weakness here too. Again, not surprising considering how far up above, but again, that's not much weakness here. It's the first red candle, which means closing below last Friday's low point. That's the first red candle that we've had in weeks. What was that, 8 weeks? We had an 8-week rally. We had 10 out of 11 weeks rally after coming up from below the 50-day moving average. So, I mean, that was, September, October has been a really couple of good months. These typically aren't. Usually, remember we talked before from a seasonality standpoint. Usually, in fact, let's take a look at that really quick. So here's the seasonality chart on SPX on TOS charts here on the charts tab. You can see again, usually from about July 15th to 19th for this year to October 15th, which is the 12th this year. So basically from expiration to expiration, roughly. That's the weakest part of the market. The weakest from a seasonal standpoint, the weakest part of the year for the S&P 500. And you can see, yeah, we had some weakness initially, but then if you just look from, from that point to this point, right about there. So, this is, from a 3, we usually have a 3.64% gain down to what is about a 0.5% gain. So we lose about 3%. Well, we went up from a 9% gain year to date, chart to date at least, up to 13%. So we had look at that discrepancy. It's a huge, huge difference from the norm. You can see that now we're kind of in the mode where here from right about November's options expiration, you can see that we finished the year pretty strong, typically from a seasonal standpoint. Now, we also had a nice little run from mid-October to the beginning of November that was bullish, as would be expected. So, we're typically during this time frame, year to date, we're up about 5%. By the time we're at this point, we're up about 3%. We're up 14 here. So on SPX. So we've had that's a discrepancy. But again, just because now this didn't match this, we think, okay, well, that weakness, this is typically strength. Maybe it will be weakness now. Maybe it's all reversed. We have to still trade what we expect, to trade what we see. It's just a matter of the fact that we're up so much, we might not get as much return, again, because the long-term trend line, we're so bullish here. We're still up. Both the 50 200-day moving averages are rising. We're still up above them, so it's not like we're going to be headed down to that 200-day moving average anytime soon. We just don't expect that. We don't expect big time tests of that long-term moving average until this MACD starts to come down a little bit. But don't be surprised if we don't just kind of meander and kind of hover above that line, especially when you look at the this chart here. It's more intermediate term chart. That MACD is rolling over, stochastics is rolling over. Remember, this slowly goes down to 0. So I wouldn't be surprised the next day or two if we don't fill in that range, head towards that support, test the 17-day moving average, because we are just a smidgen below the 8-day right now, and then maybe even close below it a little bit, but then bounce back up, slowly as these lines converge more, and then at some point we'll probably get some kind of weakness before the end of the year rally. Again, I'm basing that on past precedent, on the seasonality, and I'm basing that on what we're seeing right now with the technicals, especially with the long lower shadows we've seen over the past couple. All right, if you take a look at the intraday move, look at that intraday move. So, this is buy the dip. This is about as buy the dip as you could possibly get here. We came down to some old lows on an intraday basis over the past couple of weeks. We hit that 256.5 level, came right back up to today's high. So the high of the day was early and late because we're touching it now. The low of the day was kind of in the middle. So pretty neutral candle. Obviously lower high and a lower low, but we did finish, as of right now, we got another minute left here, but we did finish up above yesterday's low point. So that's positive. Obviously closing at the high is another positive level. So, and we are a little, we are below yet last week's high point. We basically filled in last week's range today. The high is close to the high, the low is close to the low. So 1 week's range all within 1 day on an intraday basis. But good rally towards the end of the day. A lot of volume today. Look at all that volume here. And again, we talked about this before. 80 million shares in a range of 2 points. So what did we say yesterday? Even just yesterday, we said that if we start to get more days with 1 3/4, 2 points, so not extreme. It could have been a lot more extreme and a little bit more extreme because of a gap there. But this is an extreme range. And 80 million, you can see, is above that. So even though we're only down a little bit, the bigger the ranges, the bigger the volumes, and the more these lines rise will typically lead to weakness, not so much strength. So definitely something to keep an eye on there. I also mentioned yesterday too that the odds of us picking up that extra 2 points of range on the VIX were to the upside, not so much to the downside, and all it needed was something. some catalyst in the news that the market didn't expect. And we got that today. The idea that this tax reform bill is delayed, it's only a report now, so it's not official. But this idea that this tax reform bill was delayed until 2019, that's what brought things down. Obviously not enough to keep it down as we rally back by the end of the day, but you can see now we've got about a 3-point range, just like that on the VIX, and we can now stay down here the rest of the month and just be fine. I wouldn't be surprised, like I said before, on the S&P where we fill in that range, if we don't fill in this range a little bit here and kind of hover around this 10 to 11, but now we have some long upper shadows in the volatility, which can act as a resistance level. So we probably, you can see like that one did there, we'll probably kind of meander in this area for the next little bit as we show some near-term weakness. Now we transition to what's driving the price action today, and we'll take a look here at the major asset classes. I'll zoom in on just today. Let's see, did I get today? Yep. Okay, so just today, you can see crude oil bouncing back up today, gold bouncing back up. So a little bit of geopolitical risk that's out there. All right, and of course, the tax reform bill put some pressure on equities. In U.S. more so. Initially, a lot of the weakness in equities was international. Remember, Japan had a rough night. That bled over into Europe. So a lot of the international stocks, emerging markets and developed, were weak early. And then the U.S. stocks started coming down on this reform news, tax reform news, and they caught up to the losses of these international stocks once Europe closed here. Actually, more over there. If we take a look now from the low point that stocks had to the end of the day, it was, again, equities rallied across the board, small caps more so than anybody else. And you can see that crude oil gave up some of its gains, and everything else was pretty flat. So for the day, if I just take a look at the total day, again, the two outliers to the upside was gold and energy, and the outliers to the downside were these international equities. Everything else kind of matching, U.S. stocks matching high yield, matching long-term treasuries, which were down, which means yields were up a little bit today, and the dollar being down. That's why gold did so well. So kind of an odd day, not necessarily a little bit of risk off, especially here initially. As you see treasuries, they were down, but they were outperforming equities. But then from that point on, all these safe haven areas, gold, the dollar, treasuries, all dropped. Were flat the rest of the day, and high yield bounced up along with all these other equity asset classes. So again, risk on in the afternoon, risk off early, which has been the case for the last couple of days, bled into today, and then a little bit of a bounce. Don't be surprised, again, if we don't pull back some of that and these equity classes fill in some of this, not necessarily going to new lows from today because that long lower shadow, but if we don't pull back a little bit of this and continue this risk off theme that we've had for the past few days before we establish a new near-term low point and we're able to bounce up again. From a news perspective, the only thing that came out was wholesale trade, and that didn't have an impact on interest rate hike expectations. They're pretty much the same. We're still expected to get the one in December, and then so far one more through next June, higher odds of at least one more, and you combine those two, you got pretty decent odds that we'll either get one or none by next June, and the odds of having a second one is below 20%. The GDP estimates for the fourth quarter with today's inventory data out, unchanged, still up at 3.3%, so a pretty strong number there. So from a macro perspective, nothing really came out from an economic perspective. That was the only thing on the calendar, only major thing on the calendar. You had a lot of fixed income auctions, but it was this fiscal, and that continues to be the theme, this fiscal policies that have been priced into the market. Their passing has been priced into the market, but then nothing's ever been passed yet. And so the market got a little skittish today, worrying about whether the key and what's been driving a lot of this bullish sentiment, investor sentiment over this past year, which is this corporate tax reform, how likely it is to pass, since stocks have been pricing in that it's going to pass for the past year, essentially, and especially over the past couple of months. And as I mentioned before, it does is for volatility to rise, especially when volatility is so low, extremely low, and valuations are so high. It only takes, it doesn't take much. It just takes this unexpected news to come out and spark a jump in volatility, to spark increase in trading ranges and volumes, and that will bring that intermediate pullback, even if it's just a weak bearish posture. That's what sparks that. And was today's news something that may spark that? We'll see. We'll see if there's any follow through on that the rest of the week. Again, from a technical perspective, there could be some small follow through in the next day or two before that support holds and the long-term trend kicks in. But don't expect too much of any new bounces going forward because of how overbought the intermediate trend is, and especially how overbought market sentiment is. So during the weakness today, the biggest losers were industrials and technology. Remember, technology's been the kind of the momentum trade, and you have staples doing okay, utilities, real estate kind of holding up here. Then once the market hit that bottom and started to rally, then financials, which has been really beaten up because of the drop in yields, and technology, the momentum strategy, and energy also doing very well with the jump in crude oil prices. They are the ones that led the market higher. They're the only ones that outpaced the broad market. All the safe haven areas, the healthcare, staples, utilities, real estate, materials was in there as well. But those were all the ones that lagged behind. Still some gains in the afternoon, but smaller gains, half the gains of what the broad market got. All right, so for the trade idea of the day, we'll take a look at Facebook here. We're in that technology sector, obviously one of the FANG stocks, and it's been pulling back on, you notice, some weaker volume, weaker than average. We had this kind of a big spike in volume on the bounce at the end of October, but since then, the volume's really kind of dropped off. And we got a red arrow on that MACD, which means, if you take a look at the two-line version, the MACD has crossed over its moving average, but still is positive, still strongly positive. And you notice it came down and tested the 17-day moving average, and is still, trading around the 30. It's still above a rising 30-day moving average. You can see the stochastics also below its moving average, but still relatively in a bullish position. Weak bearish. Can turn, you see starting to a little bit, turn into a stronger bullish position really easily. So when you look at all these things, you say, okay, well, it's pulling back, and there's, we saw there's been a little risk-off move this week, and it's been reflected in one of the industry leaders here. It's already had its earnings, had a nice little run-up before and after the earnings. Now pulling back after that on a lot lighter volume. So you say, okay, well, there's two ways we can do this. We can trade this. We can go ahead and trade right now the 175, and you see we're getting about the credit we need. $1.20 will get us about 30% return on risk. You notice the 175 is going to be this strike price here. That's where the moving average is. An old high here based on the stochastics and the MACD. So yeah, we could do that right now, or we can say, you know what, it hasn't bounced yet. Whoops. It hasn't bounced yet, so if there could be another couple of days of weakness in the broader market, and we know that technology's been kind of leading the market, then maybe there might be some more weakness in this. And if that's the case, then we'll come over here. I think I hit the wrong button. There we go. Then we can say, okay, well, let's look at the 170, and if it pulls back enough to where this gets up to $1.20, we can put a limit order there and say, okay, if it drops down to 173. And, if you take a look, 173 would be right about in here. So let's say it comes down and produces 3 red arrows, gets that third red arrow on the moving average, and then bounces, well, then now we can sell the 170, a little bit lower strike price, and see if it bounces off of that. So we can set a limit order at 120 to try to get in a better price. You can see it's going to take, $6 drop to get down there, and, and move the quarter today. Or we can say, you know what, how about if we were to sell the 180, see it's got the 50 delta, and buy the 175. You can see the 180 is kind of about where we're at right now, right where this 8-day moving average is. But you notice it's giving us a lot more credit than that $1.20. So in this case, we'll put the limit at $1.20, but not use a limit, use a stop limit. And say, okay, now the price has to bounce from here. We'll make sure it bounces from here before we get in to this strike price at 180, 170. So you can see, that's kind of like if this thing just starts taking off and runs away, then this is the one we want. If it keeps pulling back, then we'll do the 170, 165. If you're just not patient and you want to get in something right now, the 175, 170 has got that probability and return that fits what you typically can look for. So we got different alternatives. We can do something right now, but again, we've pulled back, but we haven't done anything. Like, we can keep pulling back or we can bounce, but it hasn't done either one. We're kind of sitting at some support with the expectation that on the broader market that there could be a couple more days of near-term pullback here. So we'll see if it plays out with two different trades. One trade if it keeps pulling back, and another trade if it starts to bounce and take off away from us. Either way, it's going to require a move up or down before either one of those trades are giving it the adequate credit. Either because right now it's either not giving nearly enough or it's giving way too much. So we need it to either bounce or drop more before we get filled into either one. And like I said, if you don't want to do either one, you can go ahead and look at that 175 right now, knowing that that's probably the most tenuous out of all of them because we don't know what the stock is going to do yet. It's at support. Is it going to bounce? It's on a bullish trend. You'd expect it to bounce. But are we going to keep pulling back down closer to 175 where I might be able to get in to a 170? Strike price instead? That's kind of the question and something to watch for. So you can see how we can take a trade idea in a market leading stock, at least in the sector that's leading, and kind of look for the right setup. And remember, we're in a market environment right now where we need to be a little picky and choosy and look for good setups instead of just going willy-nilly. Like when the market's bouncing off a deep low point with high volatility and all that, man, we can just start getting aggressive. But now when the volatility is really low and the market's really mature, the trend's really mature, we have to be a little choosy and picky and make sure we get a good setup before we get in. So to summarize, we got a pullback today. Didn't last very long. It was bigger than what we've seen for a while. It was almost a whole percent. Crazy notion, I know, but like as typical lately, it didn't last even to the close of the day. We aren't closing bigger candles at their lows, and as a result, those long lower shadows are providing support for the market. Now, that doesn't mean necessarily that we're going to bounce back up immediately. Now that we have that long lower shadow, we can trade in that range. Even if the low point can act as support, we can still trade a couple of days in that range, bringing that near-term line down. So don't be surprised if there's some moderate weakness, maybe little bit upwards, but not enough to keep the near-term line too elevated. So we get a little bit of a pullback, and then we'll start to bounce. But remember, any near-term bounce now, we've had 3 in a row. Any near-term bounce going forward from here, we wouldn't expect to last another 10, 12 days because of how high market sentiment already is and how long the intermediate posture has been strongly bullish. So again, thank you very much for watching. Click the thumbs up down below the video to let me know that you liked it. Remember to like and retweet the market outlook tweet that I pinned to the top of my Twitter feed. And of course, please fill out that survey if you haven't done so. Let us know what you think. That said, good night. Have a great one, everybody. Thanks for watching. We'll see you tomorrow.